S&P Global Ratings has issued a stark warning regarding Israel's economic outlook amid the ongoing conflict between Israel and Hamas, and the rating agency has downgraded Israel's credit outlook from stable to negative. This decision reflects a growing sense of uncertainty regarding the broader economic impact of the conflict. S&P's revision is accompanied by cautionary steps taken by Moody's Investors Service and Fitch Ratings, who have expressed concerns about Israel's credit ratings. Now, the Israel-Hamas conflict, which began with a multi-pronged assault by Hamas, has already resulted in casualties and disruptions. Israel is incurring a daily expense of approximately 1 billion shekels, equivalent to $246 million, due to the conflict in Gaza. According to Israeli Finance Minister, S&P's warning is in response to security-related disruptions, reduced business activity, increased defense spending, and the suspension of foreign tourism, all of which are contributing to economic challenges. Now, the impact of this downgrade on Israel's credit metrics is of paramount concern. S&P's decision has set the stage for a critical period in Israel's economic landscape. And if the conflict were to widen materially, it could lead to further reductions in the country's credit ratings. And thus, Israel's economic growth is expected to contract in the fourth quarter. And for more insights on this, we are being joined by Professor Leo Liederman, Chief Economic Advisor at Bank Hapoalim, live from Tel Aviv. Welcome to the broadcast, Professor.
Good morning. Thank you very much for having me in your program.
Now, I will begin my first question with S&P Global Ratings that lowered Israel's credit outlook due to concerns about the conflict. Could you elaborate on the potential consequences that this is going to have on Israel's financial stability?
Yes. As you know, Israel is in a state of war, and clearly the report and the assessment by S&P did not come as a surprise. And there is one key word that you just mentioned, and that appears in the report again and again. It is uncertainty. Basically, the Israeli economy has been a very resilient economy, including the capital market. We had over many years several episodes of hostilities and mini wars, if you want to mention that. And the Israeli economy has managed those relatively well. As a matter of fact, in financial markets, we have credit default swaps for countries, for the debt of countries traded in foreign currencies like the US dollar. And we have seen before the S&P decision and already after the beginning of the war, a widening of the CDS spread on sovereign debt of Israel from about 60 basis points on 5-year debt to about 120, 130 basis points. So I should say, markets and the rating agencies, of course, in a situation of war, would like to be cautious. And the market has already been pricing in this increased uncertainty, while at the same time, Israel's rating remains very high. And once again, we will have to wait and see because of the uncertainty.
Sure, and if we look at the disruptions in their business activities, the security-related concerns and the drafting of reservists affecting Israel's economy, and are there any specific sectors that you think that are more severely impacted as a result of the war?
Yeah, it's a very good question. The main sector that is being affected is, of course, tourism, incoming tourism. So anything related to hotels, restaurants, and so on is negatively affected. Consumer spending on goods and services, as in the case of the US economy, the UK economy, is the largest component of GDP. In Israel, consumption demand by households and individuals amounts to about 50% of GDP. And initially, we saw some stores and some shopping malls and so on closed. But we see a gradual opening of these things. And clearly, consumption is going to be affected. The mood of the consumer is, of course, quite vulnerable these days. About 400,000 people have been mobilized to the army. There is a lot of human pain and human suffering, by the way, on both sides of the conflict, in terms of relatives, in terms of people you know, that are held as hostages or that were killed with the initial stages of the war, and so on and so forth. Now, clearly, once this event is completed, I hope soon, there will be a lot of need for real investment in Israel in terms of reconstruction and the rebuilding of some of the infrastructures and some of the housing in those villages, the kibbutz, that were very dramatically affected in the border with Gaza. So over there will be some kind of a stimulus on economic activity. Overall, we think that the estimates of S&P economists about the quarterly drop in GDP this quarter, October, November, December, of about minus 5% is a realistic number.
And I mean, you've already kind of talked about rebuilding infrastructure would be on Israel's agenda. But when we talk about cost correction, the destruction that has happened as a result of the war, and now looking at cost correction in future, what do you think is Israel's immediate, course of correction going to look like?
Well, there are direct costs, indirect costs, and here it is very important as an economist to emphasize that there are two key parameters that are going to affect the costs and the overall negative impact of the war. The first one is the duration of this war. The shorter it is, the lower will be the cost, and the lower will be the damage. And second, there is the question of whether there will be an additional front of the war in the north of Israel, in the border with Lebanon, or the war will be limited to the current southern front, that is Gaza. So the shorter the war and the more concentrated it is on one front, let's say the south, then the lower will be the costs. In terms of the exact numbers, I think that it's very difficult to quantify exactly because, again, there are direct costs, there are indirect costs, like providing all kind of compensation to people that are laid off from work, to people that are taking a leave from work, help and subsidies to small and medium enterprises that basically have no incoming revenues at this time. So, there are many aspects in terms of the activities that are quite similar to the first quarter when we had the pandemic, COVID-19, namely in the second quarter of 2020. So these are some of the things, and the S&P estimates that the government budget deficit to GDP could reach a little more than 5% next year. And I think, again, here we are in full agreement with this estimate.
Thank you, Professor, for joining us live and giving us your time. Thank you for joining us.
Thank you.